In this part of the lecture for statement of cash flow, we're going to talk about uh, the direct method. Under the direct method, companies report actual cash inflows and outflows in the operating section of the statement by converting each income statement line item from the accrual basis to cash basis. So the cash collected from customers, so that would be a cash inflow, cash inflow, and of course it should be positive. The cash collected from customer, examine the activity in account receivable, which increases the sales revenue and decrease the collection. So this approach focuses on the change in receivable balance. So if you have a account receivable, you have a beginning balance, you have a ending balance. Here your credit sales, right? And here is your cash collection. So that would be the cash collected from the customer. Cash paid for merchandise. Computation of cash paid for merchandise requires two steps. Determine the purchase on the accrual basis by activity, and the computation of cash paid for the required two step. Determine how much cash the firm spent on these purchases, and the approach focuses on change in the balance sheet. So you have two balances. You have inventory, you have a beginning balance, and then you have purchase on credit, and then you have another one, the ending balance here, and then here is the cash paid to vendors. Same with the accounts payable. And then we have cash paid to employees and cash paid to other accrued expenses, including interest and expense. To compute the cash paid for accrued expense, examine the activity in related payable accounts. It could be accounts payable, it could be interest payable, and things like that. And then we can calculate how much money we have paid. To compute cash paid for insurance and other expenses, receive the activity in the related prepaid asset account. So you have a prepaid rent, for example, and you can calculate using this. Now, cash paid for other operating, including insurance and this, and then reporting cash flow from investing and financing activity. So how we do that? Cash flow from investing activity is very simple. So if you are acquiring anything, the cash is going down, means that the cash is going out, which is cash outflow. And disposition, when you are selling, the cash is coming in, so that would be a positive cash flow for investment in debt and equity. Financing is a cash receipt plus for selling, borrowing the money or selling the common stock and preferred stock. And payments would be the negative for when you are paying off your debt or you are buying back your activity. The next thing we're going to discuss, these are some of the ratios that are involved in the statement of cash flow. Number one is liquidity. Liquidity measures the ability to meet current obligation from short-term resources. For example, you have current assets and you have current liabilities. Can you meet all your current asset requirement, current assets such as using cash, account receivable to meet all your current liabilities such as accounts payable, interest payable, what we call it, payroll, all of those things you can meet using the current asset. It measures how quickly a company can convert assets into cash with minimal risk of loss. Generally, a more liquid company asset, the more is likely that the company can meet its required obligation. There are two measures. One is called working capital, other is called current ratio. Working capital is the current assets minus current liabilities, and current ratio is current assets divided by current liabilities. So is equal to the current asset minus current liabilities. When current assets are greater than current liability, indicates the company has sufficient current resources to meet its obligation. Working capital is expressed in dollars and can vary with the company size or growth. Current ratio express liquidity as the ratio of current assets to current liability. As I mentioned earlier, the current ratio indicates the proportion of current assets to each dollar. So for example, if you have current ratio is 1.5, simply means after paying all the liabilities, you can pay, if you have a liability of you have current assets say $15 and you have current liabilities of $10, means after paying the $10 of liability, you still have $5 left over for you. Solvency simply means a company's ability to meet its long-term obligations, such as bonds, equity, such as common stock and preferred stock. If the company has too much debt, there is a risk that the company firm will not be able to repay its debt and will be forced to declare bankruptcy. The ratio we're going to use here for solvency, one is our debt to equity ratio, is total debt divided by total equity. And the second one is the interest coverage ratio. So debt equity ratio is considered a leverage, is an indicator of relative size of financing from creditor versus financing from owner. So it shows how much financing is coming from within the company or the owners or the shareholders, and how much financing you are doing it from the outsider. Debt to the equity ratio is measured the leverage computed as high debt to equity ratio indicate lower solvency and greater risk of default. Means if 70% of the company is on the borrowed money, it is very easy for the people from the outside to buy this debt and take over the control of the business. Interest coverage ratio means ability to make payments on service is debt basically. So what if it is a bank and the bank wants to know whether the company would be able to pay its interest payment every month, every quarter, every year, they usually check this interest coverage ratio. Ratio indicates how many times they can cover its interest charges before taxes. So before paying taxes, how many times? Suppose you have to pay $100. So how much money you have available for this $100? If you have $100 available, that means you have one time. If you have $200 available to pay, $100 means you have twice the capacity to pay the interest coverage. DuPont analysis is a profitability calculation. It calculate the return for its shareholders. The return on equity, ROE, measures the return on shareholder investment in the company. So for example, if you purchase $1,000 shares worth of shares for any company, at the end of the day you want to know what is the return, how much money you have invested and how much return do you get. So if you get $100 for every $1,000, that means your return is 10%. Is a tool, financial statements and separate ROE into components to analyze the company sources for profitability. Free cash flow, it's a measure used to evaluate company's cash flow strength. It's less subjective than many accrual and net income based measure. Free cash flow is equal to cash flow from operating activities minus any capital expenditures. So any cash left over after capital expenditures would be considered free cash flow. This is again an important aspect of calculating the strength of the company. It provides an indication of the company cash flow available to do other things after they have replaced the assets needed to remain a going concern. So this is the final part of our three-part statement of cash flow, and we will meet for chapter 6 in the next video.